All clear.
Thank you. Welcome everybody to the Emergency Business Coalition Zotec Partners updates on the SBA CARES Act interim final rule and telehealth updates. I'm Ed Gaines, VP of Regulatory Affairs Industry Liaison for Zotec Partners. Our individual contributors will introduce themselves in a minute. We have a tremendous amount of material to get through in a very short period of time to give you all a chance to have a meaningful chat. So we're going to jump right into it and save your questions. We hope to have 15 to 20 minutes for questions. Okay, oops, there we are. Sorry about that. As we begin our fourth decade partnering with emergency physicians, Zotec honors and thanks our EM docs and their care teams. Many of us know Dr. Leah Maurer from the Seattle area, longtime member of the reimbursement committee, past Washington ACEP president. He posted this note on Twitter the other day, and I thought it was a great summary how many of us feel about the work that the ED docs and their care teams are doing from one of his neighbor girls, Maxine. Thank you for being on the front line of COVID-19 battle. Stay safe and healthy. I hope you don't get sick. God bless you and your family. So that's a great note. And then if there's probably a meaningful image that's coming out of this global pandemic, it's the one on the right from an Italian artist. Several docs, emergency docs that I know are using this as their Twitter signature image. And it's really fantastic from the artist there. There's a link to her Instagram. She's done several of these. She has a male version as well, but it's just, I think, a great reminder of the phenomenal work that y'all are doing. I want to introduce Dr. Maurer. Lisa Maurer is the past president of Wisconsin ACEP. She's a partner in emergency medicine specialist, and she's also a frequent and tireless volunteer for both ACEP and EDPMA, and want to take it and hand it over to Lisa.
Hey Ed, hi everybody. Thanks for having me be involved, and EMBC members be invited despite the shenanigans of our previous 1.0 talk. EMBC, the Emergency Medicine Business Coalition, is essentially a nationwide group of fiercely independent democratic emergency medicine groups that recognize that although the independence of our groups is of utmost importance, that together we can share best practice information about how to run our businesses successfully and even use the economies of scale to have the most competitive group purchasing possible. So we're just kicking off as a corporate entity here in the next month or so, and Ed can connect anybody who wants to learn more, but maybe more importantly, our members are, seeing decreased volumes up to 50%. I know we are in Milwaukee. And we're grappling with how to balance the solvency of our companies with kind of taking advantage of all of these federal opportunities to protect our colleagues, our employees, who are oftentimes our friends from our group. So thanks for helping to partner and host this webinar today.
Great, thank you, Lisa. All right, a little disclaimer from my favorite lawyer, Unfrozen Caveman Lawyer. This is informational information, and we're sharing this without any representations about legal advice or professional accounting advice. You need to consult with your professional advisors. We will try to highlight areas where we think it's particularly poignant for you to do so. So please remember that caveat. And now I'd like to introduce Tara Rowland, our Vice President of Sales Enablement. Tara.
Thanks, Ed. Good afternoon, everyone. And I'll second what Ed said. A huge thanks to everyone on the call. Just a few housekeeping notes. The webinar should last approximately 1 hour. Please feel free to type in any questions you have at any time throughout the webinar via the chat section located at the bottom of the Zoom dashboard on your screen. Make sure you are typing questions to everyone as opposed to sending them privately to a host or attendee. And if you do not see the chat section on your screen, you can also double click on your name to open up the section. Please note that your questions will be addressed at the end of the webcast by Dr. Maurer and our team. If we are not able to address your questions in the time allocated, we will get a response to you as soon as possible. I'd also ask that you keep your computer audio or device muted if it's not already muted. Additionally, we are recording this webinar and a link will be posted to Zotec's COVID-19 website resources pages. Those can be found on our ZPAC website at zotecpac.com and at zotecpartners.com. I will now turn the presentation over to Ed.
Great, thank you, Tara. Okay, today's agenda, I'm going to cover very quickly the background, what we covered in the 1.0, which is posted on the site that Tara just talked about. I'm going to hit a couple of highlights that just literally broke, one of which broke last night. Some that were just late breaking, so they didn't make it into the slide deck, and I'll try to highlight those for you. Then our colleague Brian Callahan's going to take you for a summary of where the PPP loan process is since our April 3rd WebEx and some of the lessons learned. And then our colleague Stacy Norris, many of you know her from ASAP reimbursement and coding and EDPMA. She's going to take you through the telehealth in the ED and related care settings, because we had a number of questions for those participated in our 1.0 WebEx about telehealth. And then Lisa's going to guide us through the Zoom chat. Okay, so the CARES Act, May 27th, 2020, $100 billion for hospitals and clinicians enrolled in Medicare and Medicaid. It is a grant program for expenses and losses attributed to the coronavirus, but it's also a fund of last resort and not to be covered up by other programs. One of the things that you have to think about here at the 200 level is how your CARES Act funds are being used, how your PPP loan proceed funds are going to be used. So it's important to keep those in mind. The amount that they paid back on Good Friday, April 10th, tranche 1 was $30 billion, but it was based on approximately 6.1% of your Medicare average reimbursements. Remember that, because they just announced details for tranche 2 last night. Those are not on the slides because the slides were already done. So I'm just going to run through that quickly. There are some issues in the terms and conditions, however, and this is a place where you're going to need to consult your advisors and your legal counsel. Originally, there was a statement on the website, and there is today from HHS saying that they believe every patient is a possible COVID patient. Then they go on to say that the patients that are treated for actual, or then the word was possible COVID, could not be balance billed. So there would be no out-of-network balance billing with respect to that cohort. Then within the last day or so, couple of days, they changed possible to presumptive. So now it says care for presumptive or actual case of COVID-19. So it's important that you go through that with your advisors and understand whether or not you think you can accept that money under those terms and conditions. The other thing that they changed since we were together in April 3rd, was if you don't do anything in terms of the attestation, you will be deemed to have accepted the terms and conditions. Now, the deadline to do so affirmatively is May 8th. Now, you might ask yourself, why do anything? Well, it's a good question. The question is, if you do nothing and you're deemed to be a negative attestation, do you get future monies? Because today the House is likely to vote on another $75 billion coming into this fund, so there will be future distributions. So there we had the first round. Let's look at some of the important provisions that are in the Act and also in the Families First. So we think about COVID 2.0, that was the Families First Act, March 18th. Then we think about the CARES Act, March 27th, as 3.0. Both of those laws together essentially said that Medicare, Medicaid, TRICARE, Medicare Advantage would pay for those services, either testing or treatment, presumably at the full allowed amount as far as the government is concerned. That those payments would be at the full allowed amount, that there would be no cost sharing, no out-of-pocket expense for the patient. Then the commercial insurers started, UHC, Aetna, Cigna, Humana, posting on their website that they too would pay for testing and treatment, mentioning doctor's office, emergency department, telehealth, with no cost sharing to the patient. Now, unfortunately, what we don't know from the plans is exactly what they're going to pay. We don't know what the payment standard is under those plans. So that we continue to worry about a little bit as it relates to that cohort of the commercial patients. Now, something's changed with regard to the uninsured. In the original statutes, the statutes envisioned that the uninsured would be paid by Medicaid, and there were actually Medicaid funds set aside. And we went through this in some detail on the April 3rd. Then there was a press conference on April 10th, and the president and the secretary of HHS said that they were going to take some of that remaining money. There's $70 billion left in that CARES Act relief fund. They were going to take some of that money and use that money to pay for the uninsured. Well, now they have actually issued some guidelines around that. And what they've said is that there will be a process. You go to the, there's a link at the HRSA.gov website, and there's in effect, a brief enrollment process, a sign-up process, and then you will bill through the HRSA program. The program will pay Medicare rates. You won't bill the patient anything. They've said that they will pay the full allowable for the uninsured. So all the more reason to capture every patient that we believe is COVID, either actual or presumptive COVID, and capture that in our documentation and with the appropriate ICD-10s. The EDPMA committee has identified that. There's an example on the website, on our website, about a macro you can use to capture that. Very important you capture that cohort of patients. But I think we're starting to see some clarity now around the process for billing for the uninsured. If no testing's available, it looks like you're going to bill that just per the patient's standard insurance. All right, very quickly, liability protections for those who volunteer. We know a number of docs that are doing it, and God bless them for doing it. The sequester cuts that have been around for a long time, those are going away May 1 for the rest of the year. The gypsy floor is going to be extended to the end of November. That's a helpful piece, and the hospitals are going to get 20% on their inpatient services for COVID treatment and testing. All right, then there's the advanced payment program. This is a separate program really run by the MACs. This is not a new program. It's been instituted before by MACs in natural disasters and public health emergencies. So it's basically a 3-month advance payment. It has to be paid back. They're going to administer the advance and they're going to administer the recoupment. They're doing this very quickly based on feedback that we've heard and experienced. And it's important for you to understand what some of those terms and conditions. On the right here, you will see an example. You don't have to pay anything for a period of 4 months, but then after 4 months, the recoupment occurs over the next 3 months. It's important that you communicate with the MAC and ask for more time. CMS has said you can do that. Get more time from the MAC if possible. The other thing to keep in mind is if you're not able to pay that money back, the interest rate is 10.25%. Now, maybe Congress is going to do away with that. A group of senators have written and said they object to CMS charging that much. CMS has said they don't have any choice. They're required by statute to charge that level of interest. All right, interim final rule. There's some teaching physician provisions, some Stark law waivers are very self-explanatory there. There's some other reg relief for the docs in the audience. You probably know this already because it's a public health emergency. There's an EMTALA waiver, but it is pursuant to the state's pandemic and emergency preparedness plan. So you can have the tent, you can have the separate screening area. It's very important for the docs. All right, so here's what's happened on the second tranche. And this was announced last night. The second tranche is going to be, sorry, as I rifle through my notes here, is going to be $20 billion of general allocation, but they've essentially changed the formula to say that $20 billion, which is going to start to be paid tomorrow, is largely going to go, as they said in their document, they said, we've been very clear that additional funds would be going out quickly to help providers with a relatively small share of their revenue coming from Medicare fee-for-service, such as children's hospitals. So now they're going to try to reach the groups and the hospitals that have a lower percentage of Medicare. So we're not expecting that many emergency physicians will get much in the way of that 20 billion. It could be some, but I wouldn't expect much. Two X factors. One, if you're in a rural area, because there's 10 billion devoted to rural areas. Also, if you're in a hot zone, or they call a high impact area, 10 billion is associated to those areas. So it's possible if you're in either one of those, you could get additional bumps in terms of that 20 billion. Then that leaves another 29.6 billion left. There's 400 million allocated for Indian Health, 29.6 billion left for the aforementioned uninsured reimbursement program and for SNFs, dentists, and Medicaid-only providers. So that's where we are with respect to tranche number 2. We'll start tomorrow, and then we'll go over a period of time. But it sounds like it's really devoted, guys, to organizations that file cost reports. You're talking about hospitals, skilled nursing facilities, other types of qualified health clinics that file cost reports. So that's not likely going to mean much for emergency medicine. But honestly, we don't know. This is changing literally on an hourly hour basis. Okay, the Senate passed CARES 3.5, as I mentioned, another 75 billion coming into that fund, which will be grant money, and then another 25 billion coming in for testing. So that's where we are as it relates to current status. CARES 4.0 is being debated right now, and Congress is scheduled to quote unquote return. We don't know what that means yet, if it's going to be virtual or actual, on May 4th. So there you have it. And Brian, I hand it over to you. Did we lose Brian?
Can you hear me?
Yeah, we can hear you.
Okay.
Yes, we can-
I thought I heard you say you lost Brian. So the launch was a little bit messy, but once the floodgates opened, it took about 9 days for the program to run out of money. As Ed mentioned, the PPP program is supposed to receive an additional 310 billion in funding. There's a large pent-up demand in the queue already from the folks whose applications did not make the first cut before the money ran out. So the second tranche of funding is expected to outpace the first round. So yeah, at a burn rate of about 40 billion to 50 billion a day in round 1, couple that with the unfunded applications already lined up, this money is not expected to last very long. Self-employed individuals, independent contractors, single member LLCs, they were largely left out of the first round. They could not submit their applications till April 10th. And by the time they had submitted to the banks, the majority of the applications just went unfunded. And as of last week, they're still writing follow-ups and frequently asked questions and documentation to help sole proprietors. The guidance wasn't released for partnership members until April 14th, so many of them went unfunded as well. There we go. So now that several groups have either received funding or hopefully they'll be receiving funding very soon, the focus of all kind of the questions have turned to loan forgiveness. And so what's important is once the PPP funds hit your account, that's the 8-week measurement race period. And that's the beginning of the 8-week period that you've got to measure. So over the next few slides, I'm going to attempt to tackle what are the most prominent questions that we're getting and the ones that we're asking ourselves to get our clients the best or the lowest amount that's unforgiven in their loans as well. So yeah, what's important is keep in mind that now where we are today, we still don't have a final SBA rules as far as how the forgiveness provisions are going to work. So we're having to use the statutes. We're having to use some of the interim financial rulings that have been in place in order to give us some level of guidance. And as Ed said, we just received some of those last night. So I'm going to try to keep up here. After the 8-week period is over, then the recipient will have to submit an application for loan forgiveness to their lender. So the important thing there is that it's the lender who's going to be making the determination as to loan forgiveness. That could be good or bad depending upon your lender, but the lender then has 60 days to work with you, clean it up, and respond to your submission. So the first item that gets asked a lot is, do the forgivable costs need to be incurred, paid, or both in the 8-week period? And so the statute's unclear, but the interpretation is incurred and paid. So what they're trying to avoid is people making back payments and people making prepayments. So if you received your money April 15th and you want to try to go backwards and reimburse yourselves for payroll that you paid in March, not able to do that. And if you're trying to throw an addition on the other end of the spectrum, if you're trying to add, like say, a rent that's due in June, that's not going to be allowed either as a forward payment. And so what I'm trying to do with my groups is, look, let's take our rent. If it's an 8-week period, let's get 2 months rent in there. If we have debt, let's make sure we have 2 monthly interest payments on the debt. And so that same concept applies if you're considering kind of like a special thank you bonus or a prepayment to payroll for folks that are under the 100,000 cap. It may be unlikely that the loan forgiveness will cover the excess salary or the forward pay. Another question that comes up quite a bit is whether or not self-rental payments can be forgiven. So if the same owners in the practice own real estate and a separate legal entity, and then they rent that property back to the practice, is that allowable? And so it's actually, the language is unclear there, and it doesn't really differentiate between related or unrelated parties when it comes to rent. So next slide. Yeah, I'm going to apologize up front. The slides get a little messy as we are a little busy as we dive into the math and look at calculating reductions for the ultimate forgiveness amount. So computing the amount of the PPP loan that's going to be eligible for forgiveness is not going to be a simple task. So what I tried to do here is just break it down into 4 easy steps that, based on the information we have today, we think is how it's going to play out. So step 1, you have 8 weeks to spend the PPP loan proceeds once you receive it on payroll, group health insurance, retirement, rent, utilities, interest on debt. Add all of those numbers together. And then the forgiveness at that point can be reduced by the next 3 rules. Rule number 1 is a headcount reduction rule. So you begin by measuring the number of full-time equivalents that you have during the 8-week measurement period. And then that is to be compared, compare that calculation to 1 of 2 baseline periods. And you take February 2019 to June 2019, or January 2020 to February 2020, and you take whatever the lower number of FTEs is. And that is because if you have a 10% reduction in your direct reduction in your full-time equivalency calculation, that's a 10% reduction in the amount that you're going to be forgiven. So there is I did it here 2 ways. I did it based on individually on week, and then I did it based upon the overall hours, just to see which way it's going to turn out, because the language is unclear when it comes to that. But there's a Hail Mary in all this, and that is if you are able to restore, if you're able to restore your head count by June 30th back to, I don't know why they chose this, but a February 15th, 2020 level, then the reduction can be excused. So the other thing is the language is silent when it comes to what if an employee just quits? Or what if the reduction of an employee has nothing or is completely unrelated to COVID-19? I have folks that just said they're not showing up, they're not coming back. I have folks that are military and they moved. So we're gonna have to see how that plays out and deal with that with our local banker and try to overcome it. Next slide. Okay, so the forgiveness amount can be reduced further by any amount or any reduction in salary or wages for those people under the 100,000 cap. So the reduction is not required for those making over $100,000 proportionately in 2019. So first thing you do is you determine the average salary for an 8-week period, and they have you compare that to Q1 2020. So that's obviously 12 weeks. So they force you to figure that out per week. And so once you're, what I'm trying to show to the right here is if I took an individual and said they made $90,000 and reduced that to a first quarter period per week, and then reduced their pay and did it per week as well, so that we have an even comparison. And then if you look at the first example, their pay was reduced 80%. If their pay is reduced below 75%, then you have a dollar for dollar reduction in your forgiveness amount. So on the right-hand side, I took that same person, reduced their pay to 63%. And so you take the delta, the difference between the 63 and the 75, and that's the amount that's unforgiven for any individual. So again, if the salary decreases more than 25%, then you're going to have a portion that is unforgiven in the loan. Next. Okay, so step 4, the overall purpose of the program is to keep people working, right? And it's to help companies retain staff. So under the interim rules of the SBA, they introduced the concept of a 75-25 rule. And so what that means is if you do not spend at least 75% of the loan proceeds on payroll costs, then the dollar amount of the shortfall from 75% reduces the overall forgiveness amount. So therefore, you cannot have your non-payroll cost exceed 25%. So what I try to do on the right here is a simple kind of walkthrough. This would be, I received $500,000 in funds. I spent 75% on payroll costs, 25% on non-payroll costs, and I'm completely forgiven. However, on the right-hand side, I took the same example and said, well, look, I spent everything on allowable costs under the plan, and I had a difference of $1,500. But I did not, but what happened was I missed the 75% payroll mark. So because I missed that mark, I now owe $10,000 back. So if your average monthly payroll has declined since the 12-month period that you use to compute the calculation to achieve the loan, then you're going to have a reduction in the amount. So that's many folks are going to struggle to reach that 75% absolute loan forgiveness number. Next slide. So on April 14th, which is 2 days before funding ran out on the 16th, the SBA came up with additional interim financial rule or final rules to address sole proprietors and partnerships. So what they said is if you're an independent contractor, unincorporated sole proprietor, single member LLC, you're disregarded for tax purposes, and you file your business income and expenses on a Schedule C on your individual return, then you have to estimate what you believe your 2020 you're going to have to estimate what you believe is going to be that net profit or loss from your business, and then divide that by 12, multiply it by 2.5, cap it at $100,000. So if you fall into the sole proprietor realm, the max amount of a loan that you're going to be able to achieve is $20,000. And because that is your your quote unquote self-employment income, no other expenses qualify for forgiveness. So you're going to receive $20,833. The top level that you're able, the way it's written now, the top level you'll be able to achieve for forgiveness is $15,300. So you've got a $5,500 delta right there. So we'll see if that's the language is sloppy or if they're going to just leave it as is. Partners in a partnership have to file together as a partnership. They cannot file separately. And so your self-employment income is derived from your K-1, right? That gets reported to you. And that number is what they're going to use as your payroll costs up to the $100,000 cap. So they're capped as well. This still isn't really nailed down because what if I had zero income, but I had guaranteed payments? Those are not accounted for in the language. How do I measure what my P&L is actually going to look like over an 8-week period? So I think the attempt to clarify that on the SBA's behalf just kind of really generated more questions than it did answers. So next slide. Okay, and then the last item that has generated a lot of questions is if we have received our PPP loan money or are receiving it, how does that interact with the accounting for the HHS provider relief funds that we received as well? And so if you look at the terms and conditions sheet, this is what stands out. The recipient certifies that it will not use the payments to reimburse expenses or losses that have been reimbursed from other sources, or that other sources are obligated to reimburse under, and they use the language, but it's under the COVID 1, 2, 3, and 3.5 legislation. So automatically that means you have two commingled funds that you're going to have to separate out. And so what our take on this is do not use the HHS funds for payroll costs. Don't use them for benefits, rent, utilities, interest, all those things that are covered under the PPP plan. Do not use the HHS funds. This is my take. Do not use the HHS funds to make up the salary shortfalls for those folks over the 100,000. Instead, kind of the recommendation is keep it clean. Use the HHS money for malpractice insurance, contract labor, new technology, PPE, because the terms sheet also states that there's going to be an accounting for the funds that takes place at the end of each quarter. I don't know how many quarters. It doesn't really spell that out, so they're going to have to clarify that as well. So our suggestion is track these funds separately. As you make payments for things that are allowable, accumulate the documents then, and so that way you'll have it available when the time comes that you have to do the reporting and the accounting on this. I think I probably ran over my allotted time. There's a lot to unpack there, and I'm sorry if I went fast, but there's a lot to cover. So Stacy, I'll turn it over to you.
Great. Thank you, Brian. Stacy?
Okay. Thank you so much. Okay. Hello, everyone. I'm Stacy Norris. I'm going to talk for a few minutes about the coding changes to do with telehealth and CMS broadening the way that we can all code and bill appropriately for telehealth during this public health emergency. So I just wanted to briefly, in the first two slides, give you an idea of how strict and how limited things were prior to this public health emergency, as far as billing for telehealth, and especially for emergency medicine providers. So prior to this change with COVID-19, CMS had very strict guidelines in place that prohibited most ED providers from billing for them. I won't say all, but in most cases, ED providers could not. And I'll explain briefly why. So CMS had very strict definitions of, an originating site. And that site is where the patient was. So the patient was at an originating site. That could not be at the patient's home, except for certain specific instances, such as the treatment of substance use disorder. There were certain specific patient conditions that you could, but for the most part, it could not be the patient's home. So they had to go into some sort of medical facility. And then further than that, that originating site had to be in either a HIPS area, and those that deal with billing know what a HIPS is, but that's for those that do not, that's a health professional shortage area. And it relates to an increased payment from CMS in certain circumstances for these HIPSA areas in rural areas. So the originating site had to be in a HIPSA area or outside of a MSA or a large city area, metropolitan statistical area. And how you would do that, you would have to go on the CMS website where they have HIPSA information and MSA information, look that up and make sure that your originating site was within one of these areas. Next slide, please. And so then the next steps prior to this PHE, you would go into, and I put the link there. And the reason I put the link also is both for just general telehealth information, and you can still go to the same link and it's going to give you the updated telehealth information, which I'll talk about in a few minutes. But you would go to this link, check and see if the code that you were trying to bill for the service provided was on that list of acceptable telehealth services. And prior to the PHE, ED&M services 99281 through 99285 were not on that list. Neither was critical care. Neither was observation services. So you can see pretty much anything the ED provider would bill for was not on that list. So office and other outpatient codes, which, physician office codes were there, subsequent hospital care codes were there, but not the new hospital care codes, new patient. So also another thing, if you were billing outside of CMS, you also would check in your CPT book in Appendix P, and there it listed the CPT codes that were typically performed, that could be performed via telehealth. And again, it was equal to the CMS list. No ED&M critical care codes or OBS codes were in that Appendix P for 2020. Next slide, please. So, but with the public health emergency with COVID-19, everything has changed now. It has broadened so that the ED providers, can bill for telehealth services. So on March 20th is when CMS issued this new guidance. They issued some additional guidance a couple of days before that wasn't completely broadening it the way it should have been. Then after some discussions, the main guidance was issued on 3/20 that really broadened the scope of telehealth services, and most especially for ED providers. So that is the policy issued on 3/20 is retroactive back to services, date of service back to 3/1 to March 1st. Now that originating site that I just mentioned, requirement was suspended. So now, the patient can receive those telehealth services in their home. Excuse me. The distant site requirement, which is where the provider was, that's telehealth speak for where the provider who's providing the telehealth was located at. That's been suspended. Previously to the PHE, providers could not be in their home and provide telehealth. So now, of course, they can under this waiver. The rural health location requirement completely suspended. That now you don't have to consider whether or not that patient is in a HIPS or MSA outside of an MSA area. So it's not limited in that way. It can be provided anywhere. The place of service requirement of O2, which is the place of service requirement prior to this public health emergency that had to be used for telehealth services, is also suspended. Now the CMS instruction is to use the place of service code that would have been reported had the service occurred in person. So for example, for our ED&M services, 99281 through 99285, and our critical care services, etc., those are emergency department services, and those are going to be reported with place of service 23, not place of service 02. Next slide, please. Just wait for the slide to catch up. And then from a modifier standpoint, which of course is very important to us coders, so CPT modifier 95, that is not a new modifier. That's been there, and that was to be applied to telehealth services CMS had changed that requirement a little bit over the years with place of service 02, which is the telehealth place of service. They didn't require it, but because the place of service 02 basically indicated the telehealth service. But now for this current COVID public health emergency, we do need to apply CPT modifier 95, which is indicating our telemedicine service. So that's going to be applied to any claim lines that describe services furnished via telehealth, and payment that will then be consistent with that place of service. So in that way, there's no concern about facility or non-facility payment. It's going that part of it's going to be taken care of by your place of service, and it should be correct that way. To see those covered telehealth services that are covered under the public health emergency, again, you're going to go to that list of telehealth services link that I provided on the previous slide, and you can clearly see that for yourself. So it's an Excel, and it gives you all the codes, and you're going to see, for example, ED/NM codes 99281 through 99285, and on the spreadsheet it's going to say these are temporary additions for the PHE for the COVID-19 pandemic. So it's very clear that they were added just for that. Of course, we have yet to see if they'll be removed after this, but for right now, for this public health emergency, they are effective. And that's for our ED/NM visits, our critical care visits, and our observation services code, among many other codes on that list. And I just wanted to give just one quick mention to another modifier CS. I didn't include on the slide just because, we're talking about telehealth services in particular. And the 95 is the one that it does apply directly to telehealth services only, because that's the definition of the modifier. However, you need to be aware of modifier CS, which is the cost sharing modifier, cost sharing waiver. And now this is also going to need to be on all your COVID related services, not just telehealth. And that was in a very clear Medlearn Matters article that CMS issued on the subject. And what that modifier does is going to indicate to CMS that Medicare patients will not be charged any co-insurance or deductible amounts for those services, and then Medicare should come back and pay the full allowable amount for that service. And it is supposed to be applied for CMS for all visits that either result in an order for a COVID-19 test, are related to furnishing such a test, or very important, for the evaluation of the individual for determining the need for such a test. So, we've had a lot of questions as, well, do you only use it if the test is given? And no, the CMS guidance is also for the evaluation of determining, if the patient needs the test. Okay, so getting back to our slide here, covered telehealth services still do require telecommunications technology that has audio and video capabilities, two-way, real-time audio and video capabilities, and that's the same as the requirement prior to the public health emergency. So that hasn't changed. So phones that have audio and video capabilities are acceptable. They meet this requirement. The CMS also did in their guidance, provide some detail as far as, FaceTime specifically, Skype is acceptable. Using those types of apps, and services on your phone is acceptable. However, they were clear to say that public-facing apps and services such as FaceTime Live, TikTok, etc., not acceptable, because obviously you're going to be sharing everything with the world there. And even though a lot of things have been waived, that certainly, isn't still not acceptable. So be careful about that. But apps that are one-to-one, such as FaceTime and Skype, are acceptable. I mentioned the COVID-19 FAQ document here on the slide, which is a very, very helpful document. I recommend everybody read that one. We provide the links at the end of the presentation here. They were very clear in that FAQ, and this was a very big question for ED providers, whether on-site visits conducted via video or through a window, but in the same clinic suite, aka same area, same hospital area, due to exposure risks. So the patient may be in a room, the provider may be, it could be outside a door, it could be, a little further away than that even, but they're not face-to-face, they're not in the same room. Whether that is considered telehealth or not, and Medicare clearly answered the question, the FAQs, that's not a telehealth service. That would just be reported as your normal service. So in other words, if that was a, moderate level service reported with a, 99283, E&M code, then you would go ahead and report that with a 99283. You would not need to apply the modifier 95 to indicate that's a telehealth service, but you would need to apply your CS modifier if indeed it is a COVID-related service evaluation. So that was a very important bit of information that we needed to proceed with our programs. And then lastly, I just wanted to mention real quick that documentation requirements for the codes themselves, however, have not changed. So this is great that all this is opened up, but we still have to look at our CPD book and look very carefully at our codes and be sure that the services that are being provided are ED E&M services, for example, or OPS or critical care, whatever it may be. So just be very careful. Don't look at this as every requirement is thrown out, because it's not. You still have to make sure and pick the appropriate code for the appropriate service. Okay, next slide. And then this is just the just some links with really, really helpful information from CMS. I would recommend, everyone on the call definitely download these documents and become familiar with them. Okay.
Okay, thank you, Stacy. Appreciate it.
Sure.
And Brian also. Let me move on. Here's a summary page. We will skip over that for right now. Here is some information about where you can direct questions. Let's do a stop share. And Tara, if I'm doing something incorrectly, please holler. And let's start the chat. Lisa, if you'd like to guide us through the chat process, please.
Sure thing. So as expected, we have some really good questions, which I'm interested to hear the answers to. So seeing as we were talking about telehealth and coding there, I'll just kind of keep going with that kick. The first question was specifically as we're using telehealth to see our patients who might physically be in the emergency department. Now, as you just explained, Stacy, if both the patient and the provider are in the same physical space, it's not really considered telehealth. But as we're exploring these different modalities, say an APP sees a patient, and we're intending that to be a shared visit for a physician to also evaluate that patient. Is telephone, for example, calling into the room sufficient for that visit to be considered shared? Or would there have to be an audio and visual component to that physician encounter?
Wow, that's a really good question. I don't think I've seen that particularly addressed anywhere. I would say, and I would like to do some research and follow up on this, after the call, but I would say that everything from CMS has indicated, that there would still, since we're talking about billing out under a shared visit, face-to-face visit guidelines, that we would still need an audio-visual component there, because, prior to this, the requirement was, face-to-face visit, obviously by the physician to do that, unless somebody has some information different from that.
Okay, perfect. And then I think other people are starting to, as we're exploring doing telehealth without that originating site limitation, people are thinking about using that patient being in their home as a good opportunity for us to take care of our patients. So for example, if the patient's at home, say we've seen them in the emergency department just recently, and we want to kind of follow up with them with a telehealth platform, audio and visual. Is there a code or a value assigned to a code for that kind of encounter? Say, for example, a COVID presumed positive patient, we want to follow up with them via telehealth in the day or two after their ED encounter.
Yeah, for those types of, and we're getting a lot of questions like that also specifically with our clients with, just different scenarios like this. You're still going to, as I said, the definitions for the codes themselves haven't changed. So we're still going to have to look carefully and make sure that the services we're providing, meet the definition of an ED visit, which is unscheduled episodic care. Now, that being said, of course, providers, certainly ED providers obviously tell patients to follow up with them and ED is needed. But the difference is if you have a scheduled visit, then that's taking it out of the realm of the ED type visit. So then you would need to look at a different set of codes if it's truly a scheduled follow-up. More to the office or outpatient codes. Of course, there's other types of, there's the follow-up codes that they're the virtual check-in codes, but then of course those have their own nuances with them because it, can't have resulted for an E&M within 7 days. So I would just say, you need to look at the codes that are out there, but if you're gonna use the ED E&M codes, you need to make sure that that's truly what you're providing and it still meets the definition of that code set.
Right. So to the person who asked the question, it seems that this is more of a follow-up from an ED. It's kind of maybe an expected encounter rather than the patient reaching out to the provider as a, a unscheduled care. It seems maybe more consistent with the outpatient code, but it might depend on the nature of the encounter itself. And then the last question I have at this point, which we might have room for a few more, so if folks want to throw other questions on the chat box, I'm happy to field that as well. But as we're also reaching out to our patients in home, we're oftentimes partnering with EMS to do so. And say EMS is kind of partnering with an emergency physician, they are going to actually be in person in the patient's home. And then we might evaluate the patient via, telehealth, via like a virtual platform that the EMS provider actually brings to the home, like an iPad or something like that. Is there an actual code or mechanism for billing for EMS's role in that partnership? I know some of the pilot programs are being delayed, but is there a mechanism to get reimbursement for the EMS portion of that kind of paired evaluation in a patient's home that you know of?
I mean, I haven't had that specific scenario that I've researched yet, but I mean, I would say that, if our ED provider is providing a service, and as long as, that patient contact is there via audiovisual or via telephone, whatever, there should be a code to capture it, yes. Yeah, I mean, I definitely think so. But it's going to...
Yeah, for the paramedic involved, it kind of boils down to going to the patient's home without transport, right? So it seems like there's truly a mechanism for the physician involved, but the EMS provider is kind of the question there.
Oh, okay.
Right, Lisa, this is Ed. So the ET3 program, which had been announced some time ago, was officially delayed, and that would definitely address the situation that you're describing. So they get the 911 call, and perhaps the APP is riding in EMS and actually does either care on site, does a telemed visit, or they take them not to the emergency department, but another care setting. So that whole model, it's called the ET3 model, is going to be deferred until, I believe, the fall. So that one's on hold for now, but that program was squarely designed for the kind of scenario you're describing.
Thanks. And as a follow-up to our previous discussion about the in-home visit, using the office codes, does it kind of bring up a complication seeing as there's no established patient and provider relationship? My understanding was that for a lot of those codes is used for telehealth during this PHE, that the established patient relationship was removed, but I just want to have Ed's shaking head, make sure I'm right, and maybe Casey confirm.
Yes, I am shaking my head. Yes, the new and established requirement was lifted during the public health emergency, but again, it's the kind of thing, as Stacy was alluding to, what happens after the PHE is over is going to be anybody's guess. It's going to be a little bit of the Wild West, because a lot of these rules have been relaxed, and the question is what comes back. That concept of new and established is in CPT, so it's not just a Medicare issue, it's an all-payer issue.
Thanks, Ed. And I think the rest of the questions I have right now switch gears, going back to Brian's section of the talk.
Lisa, can I add just one other thing before we leave? I mentioned the allocation in tranche 2 that was announced just last night. We have a document on our website and the web link that we referred to earlier that summarizes the details around tranche 2 for those that are interested in knowing more about it. Also, on the terms and conditions for tranche 1, there's an issue around whether or not those funds can apply to an individual who makes higher than an executive level 2 salary for the federal government, and that level is $197,300. The question is whether or not you can apply any of those CARES Act funds to somebody that makes more than that, or if they've had to take a 50% pay reduction because of volume losses, could you apply some of those CARES Act funds up to $197,300? Those are questions you should consult with your legal advisors about, because it's important before you do that certification that you know what the answer is and how you can allocate those funds.
Gets stickier. Thanks, Ed.
Yeah.
So one question, Brian, was regarding the reduction for those folks. If you're reducing, it's about qualifying for forgiveness, okay? So in salary reduction, I think you clarified that this applies only to folks who traditionally at their baseline make less than that $100,000 annualized, but there was a question specifically for, say, typically someone makes $200,000 in like 2019, for example, but right now, annualized for their current salary, they're making $105,000. Would a reduction in their salary effectively reduce the forgivable amount in that PPP loan?
So there's two pieces of that. Number one, they wouldn't qualify for any reduction for the wage reduction rule, because if they were around last year at a level that was above 100,000, they're removed from that calculation. But there's the step 4 big picture: is my salary going to be, or all the summation of my salary is going to be at least 75% of the total loan proceeds. So you wouldn't be hit by the wage reduction rule, but you will have to still obviously consider the total big picture of the 75 spent on payroll costs and the 25 on non-payroll costs.
Okay, perfect. Thank you.
Make sense? Yeah.
I think someone just wanted to clarify, you know, the head count reduction rule as we're kind of calculating any reduction in the forgivable amounts from the PPP loan. So there's really no role in kind of counting the folks who are on the number of people on your payroll. It's really the number of hours that the people on your payroll are working, because it's the hours that are used to calculate the FTEs. It has nothing to do with the number of people that are on your payroll. I know a lot of EM groups are potentially not letting folks go now who are their employees, but they certainly are working less hours in many groups. Can you clarify that that's in fact true?
Yes, that's true. So it's based upon hours only. And the other, so that's just one reduction that you could possibly have. Mm-hmm. And so the answer to that really becomes, if you restore those hours by June 30th, back to your February timeframe, then there's no reduction at all to worry about.
And might you specifically be able to comment about, you know, so say the distribution of those PPP funds occurred in the last couple of weeks for many who applied. The extension of the application of those funds then would go over the subsequent 8 weeks and through to the middle of June. I assume that it's at that time that we would be applying for forgiveness for those loaned funds. And it's hard to then predict who and how many hours will be on the payroll on June 30th. Will there be a delay in that application for forgiveness, or to be determined, I guess?
Yeah, I think it's to be determined, only because the bank has 60 days from the day you submit your application to be forgiven to respond to you. So I think that's why there's a little bit of a gap in there. Mm-hmm. But my understanding, the way it's currently written, talking to banks, once your 8-week period is over, that's when you're going to have to submit for what you believe your loan forgiveness is going to be, and the math behind it.
Okay. And the last question I have on the Stump the Brian game is, so as you're considering what different expenses are applicable for forgiveness, we're talking about health insurance costs, health insurance premiums. What if your group is self-insured, where really a minority of your costs are that premium to your third-party administrator, but a big portion of your costs are claims that you pay? Do you know if those claims that you pay are eligible for forgivable costs, or is that are the laws silent on that?
So here's the language, and this is what I would go by. The payment required for the provision of group health care benefits, which includes insurance premiums. So under that language, I would say both apply. That would be, because it's saying, what provisions do you have for group healthcare benefits,
Mhm.
which making a payment in a self-funded program would be, and then the comma, including insurance premiums. So it's including insurance premiums, not solely insurance premiums. That is one way to read that.
Okay, really helpful. Thank you so much, Brian. We have failed in trying to stump you, I think.
Well,
Those are all
I'm
the
sure that'll be
questions.
easy.
Those are all the questions I have. Actually, one more just popped in. Do we know if the reporting requirements for the CARES relief funds, do we know what the reporting requirements are for the relief funds received over those 150,000?
Yeah, so that's a great question, and the answer is no, we do not know the specific requirements. I think Brian was alluding, there's a quarterly requirement on reporting. We know some very broad outlines. I mentioned the executive level $297,300 issue. There are other provisions in those terms and conditions. So we're waiting to see what the detail will be around that quarterly reporting. I think we're right up to the hour. I want to thank again Lisa, Stacy, Brian, and Tara, and all of you for participating. Really appreciate the questions and the dialogue, and the presenters, and Tara for herding us cats, which is never an easy task. And Lisa's Stump the Brian at the end was excellent. So thank you for that. If you have questions, let us know. We will be posting a recording of this on the website. For those who did not hear 1.0 that we did April 3rd, that recording is out there. So it might be helpful to go back to that, listen to that, and then listen to this one to give you a better sense of the overall picture. But with that, we'll call it a day, and thank you all very much.